Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here on the Smart Investing Show. Gosh, we got so many things to cover today. We are going to be talking about at the beginning of the show, the volatility of stocks. That did happen this past week. Also talk about the CPI and the PPI, which is the Consumer Price Index and Producer Price Index. Very important numbers because next week is when the Fed meets. Are going to raise rates or not? This is some of the data that they look at. And then also, too, gas prices. We'll talk about behind the scenes what is going on with gas prices. And with me is Chase. Hey, Chase.
Hey there. Good to be here. And
where's the vest?
You know, no vest today. It's the weekend. It's a sweatshirt, nice hoodie. You know, I feel like Mark Zuckerberg.
And actually, we'll give a plug for your foundation because that's what the sweatshirt is.
Yeah, and the Fighters Fight Foundation. Nice, comfortable sweatshirt on this cool morning. It's supposed to be 75 today, though, so that's going to be kind of nice.
I'm looking forward to sitting out by my pool and reading my Barron's magazine.
And next week we go back to the rain, too,
yeah,
so that'll be cool. But anyways, not a weather talk show. You want to join the show, phone number here, 833-288-0973. Again, 833-288-0973. But I know, as you said, we got a lot to talk about before we go to the calls there.
And I do want to tell people because it's kind of being known now. Like, people see me in a suit. They know I wear a suit all the time. Your thing has been for now years, you don't wear a suit, you wear a vest. And people are starting to kind of recognize you by wearing the vest. So that's if they see you on TV, like, yeah, he always does wear a vest.
Best guy.
You're best guy. You don't wear a suit coat unless, well, maybe at my wedding you will.
I don't know. I wore one at my wedding, but yeah, the jacket just, I feel like I'm like in a straight jacket and I'm contained and I'm like, I just want to break free.
You're a vest guy. So, I mean, you might see Chase on the beach in his vest. Who knows? Hey. All right. Well, let's move on and talk about what's going on here. The volatility of stocks, and it just amazes me how people believe that stocks are too risky. And this is a great time to talk about this and how real estate is much safer. Looking back nearly 50 years, the truth is stocks have more volatility than real estate. Yes, that is true. But the return on stocks far outperform real estate. Using a nationwide real estate index versus the S&P 500 from 1975 to 2022, a $100 investment. And again, I know you can't buy real estate for $100, but they're using this as an indicator. A $100 investment in U.S. real estate would be up about 9 times to 928. You're thinking, wow, that's a pretty good return. I'd be very happy with that. Compare this to $100 invested in the S&P 500 from 1975 to 2022. That would have grown to $19,351. From 1990 to 2006, there was a period known as the Great Moderation, where real estate outperformed the S&P 500, and that's over now.
Yeah, I mean, that's definitely over. But looking back on history and realizing how much real estate has increased because of COVID, I mean, I do begin to wonder if we could be in for a long-term period of slowly increasing real estate and after inflation, perhaps a negative return. People do tend to look at the recent history, which can fool one to making poor investment decisions. People think just because something went up in the past, it'll continue to do the same thing going forward, but they do not realize that great advancements can lead to moderation for years to come. Why do people do so poorly in stocks? They confuse the volatility with risk, and many times during a short-term decline in equities, well, they will head for the exits and miss the great long-term returns that good, solid equities can provide those investors.
And that's what's going on right now, Chase. I mean, we got the banking situation. Yes, we had 3 banks fail. People are like, oh, I'm getting out of stocks. Stocks are too risky. And they're missing the best returns. And actually today on the front page of Barron's, what's it say? Buy the big banks.
Yep.
That's what we're doing. I mean, that's what you do. You don't run to the exits. And I don't like when people say this. Well, I'm gonna sell now. And you know what I'm going to say? I'm going to sell now and come back when things are better. What that means is I am selling low and buying high.
Yeah, and it's like they think like, oh, I'm just going to I just can't handle this volatility right now.
Right.
Well, if you can't handle volatility now, What's going to change in 6 months? Or there's always going to be volatility. Like, that just tells me you're not going to do well in stocks, and just you're not going to do well investing, period.
Yes.
And it's just a awful decision that people make. And we always have this saying that investing is simple, but it's not easy. Now, what does that mean? Yeah, it's pretty darn simple to go out and buy a stock now, right? And even taking it one step further, the concept of investing, buying a good company at a low price, yeah, that makes sense.
Yep.
Simple concept. The part that is not easy, or I guess there's two parts that are not easy, is number one, the research. You have to make sure you're getting a good business at a good price. And number two, it's not easy to go through these difficult times. It is hard to kind of watch the portfolios go up and down. But that's why if you take that longer term view, 2 to 3 years down the road rather than 2 to 3 days, it does kind of help ease some of that pressure. But people get so fixated on it, and they make the worst decisions during these periods. I truly believe that it's during these periods that the most money is made.
Oh, yeah. Yeah. And I learned that 20 years ago, that you make most of your money during a bear market. But people want to miss the bear market, and we tell people of a 7-year period, you are going to have a couple losing years. That's going to happen. You're going to have losing quarters, losing months. That's going to happen. But it's the volatility. It is not really a loss because you don't sell it. It's just what somebody else sold at, and that's the price they got. Doesn't mean you have to do that. And the same thing can happen with real estate. But the difference is equities do so much better. But people refuse to ride the course. They think this is the last time it's going to be over. And I've now gone through, after this now, probably, 21 corrections in my 40-plus years of doing this. And every single time, this is the only thing I can say, every single time had the same result. It was higher a year or two later, many times much less than that. So why? Why do you sell when things are low? Ask yourself that question because you're afraid maybe losing more, which you may. Oh, I should have sold back then. Yeah, maybe you should have. But look down the road, 12, 24 months. Gosh, I'm glad I didn't sell.
And the funny thing is, when we tell people, it's like, hey, would you be happy with an 8, 10, maybe 12% return on average? Yeah, that'd be great. No, I got to get out. The things are terrible. Well, if you can time it, that tells me you're not expecting a 10% return. That tells me you're going for a 30, 40% return because you think you're going to be able to time the bottom and then the upswing is going to be a 50%. There's no way to do that.
Right.
And again, we're very upfront. We tell people, we're not market timers. I'm not trying to be a hedge fund and short and do all these crazy things and end up, charging our clients all this money and then end up being very risky. That's how you don't make money in the long term, by trying to do just silly things. And I did want to say as well, with the real estate side of the equation, is I'm not going to knock the study necessarily, but I can see where some people might be saying, well, yeah, but there is the cost to rent. Right. And that is true. So that doesn't factor that into the equation. But I will say, I was looking at my house that I rent currently versus what it would cost me to buy it.
We both rent, by the way.
Both rent. What it would cost me to buy it. And in terms of cash flow, my cash flow would be about a few $1,000s less every single month. People are, yeah, but you're putting it into the house. But my counterpoint is, yeah, but now that money's not going into investments.
Right.
So, again, that's where it looks at what is the cash flow. And I think there'll be a time where real estate does make more sense. And if you can get closer to rent and the cash flow on that house being closer, yeah, you can make that argument. But right now, I'm just losing too much cash flow by buying and not being able to invest. I mean, you talk about not investing in a 401k, a Roth IRA, you're missing huge tax benefits as well.
Exactly. And the other thing, too, with real estate, and again, there are times that people should buy a house. We've talked about for you want to raise a family. You probably do want to buy a house so you can stay in that school district and so forth. But the other thing, too, with real estate is that you had to come up with a down payment. Yep. And that's 20%. So $1 million home, you've got to come up with $200,000. Well, that $200,000 now is dead money because of the fact that you can't invest that money. Now you do have the benefits of leveraging, because now if the house goes up 10%, it's only really, over time, it's really based on your $200,000 investment plus the payments. So there are some benefits, but the point that I will try and get across to people, we're not saying don't buy a house, buy a house. Yeah. We're saying that investing is good. Stay the course. You'll get those big returns over 20, 30 years. And I get so excited. Like my other son, Nash, who's 20? I mean, he's putting away money. Christina's son, Ethan, he's putting away money. I mean, these young kids that are 20, 21 years old, they have no idea what that money's going to be worth. It's going to be worth millions of dollars because they're on the right track. And just, I'm going to say you got to keep on track, because I could be around for 30 more years. Then, you're going to have to help them through that time frame. But it's just, get investing, and I love to see young people invest and get started.
Yeah, no, it's important, and I don't know if we want to talk about it now, but I did kind of want to obviously talk about the Silicon Valley Bank situation.
We can switch to that, yeah.
I just, obviously, it's been a week now since our last show, where it was kind of fresh news last week, but, you kind of started to get more information. We're talking, and, this may be a little more political than investing, but right. When we look at the Silicon Valley Bank situation, I think it was a huge mistake to actually help those people that didn't have insured deposits. I think it does create a very dangerous situation of saying, oh, yeah, no, all deposits shouldn't be safe.
Yeah.
Capitalism, we need failure.
Yes.
And right now, just to let these people off the hook, and I'm going to say it's kind of funny as well. It's like, oh, no, we're going after the billionaires. Well, guess who banks at Silicon Valley Bank? It's just crazy to me. And I think there were some things they could have done to help small businesses. But again, the billionaires that lost $50 million there, why in the heck would you have $50 million in a risky bank? That's more of an investment to me than a cash account.
Yeah, and you wouldn't need to, because there are smaller businesses that might have payroll that is $500,000, $1 million. Yeah, they might need to have it in there. So maybe raise it to a higher level. And this is the second time this year, what I'm going to say, I'm going to agree with Elizabeth Warren on something, because she came out saying that maybe there should be, because your average person doesn't need more than $250,000 insured. But a business does, because if you're like a small business, you have a payroll for 30, 40 people, that's probably maybe $1 million. You've got to have that in the bank to meet payroll. Yep. So maybe there should be a higher limit for businesses. And the other thing that we both agreed on is just like banks should be boring, which he said. And that was very important. Banks are not there to speculate and do all these crazy things like Silicon Bank did. That's why they had problems.
Yeah, and these big banks don't want to buy their assets because they're crap assets.
Yeah, toxic.
They're not good loans. And I think that's why I still feel so comfortable in the financial world. Right. The financial system's not broken. People, think this is, again, a Lehman moment. I don't think this is a Lehman moment. I think this is a very isolated occurrence that happened with these high-risk banks. And I still continue to believe there's going to be other high-risk banks. And I do think there could be some unfortunate situations where there are bank runs on some smaller banks as well. That is going to be difficult. Obviously, First Republic's been in the news a lot. And I think they could potentially sell. I know they said that's an unlikely situation, but if there is a continued bank run on them, they may have to sell. But I think they actually have good loans, where Silicon Valley had terrible loans. So I think just looking at it on a case-by-case basis is going to be very important. And I think the big banks, again, I think they're extremely safe. And they've actually seen deposits come into them, so I think they're going to have no problems.
Yeah, what was it? I think B of A said $15 billion last weekend or something. I'm not sure what JP Morgan, Wells Fargo, and so forth. But the other thing, too, is that you just have to kind of step back. And the other thing the bank did, too, was they kind of had an agreement, like, we're going to loan you this money, for this high-risk venture that you're doing. But you got to kind of put your other money here with us as well, which is a banking relationship. But they did so many of those risky loans, we'll call it, that their deposits were risky because they were all based on these startup-type companies where when things slow down, they need money. Yep. So that's the other thing, too, is banks need to – this has never come up before, never even thought about it. Actually, that's not true. Back in the oil bust in Texas, they had some banks that all their customers at the banks were oil people. And when oil went down, everybody's losing money. So there should be a thing maybe that banks should have a diversified deposit base that, yes, I want that relationship with you, but I can't have more than 25% of my business come from tech startup companies or from oil companies. You should diversify. And that's a business decision. That was a poor move by that bank.
Yeah, and the thing that, again, I people might be surprised by this, but I'm for regulation.
Yeah.
I'm just not for stupid regulation.
There we go.
And I think a lot of times people go overboard and say, you see, we need to regulate more. And it's like, what about smart regulation? We don't just need to add regulation, add regulation. And I'm going to be a little perturbed if they add more regulation to the big banks. I don't think you need more regulation. No. There's no issues there.
Right.
And the thing is that also kind of is frustrating is it seems like the big banks and the other banks are going to have to pay for essentially Silicon Valley Bank's failure, Signature Bank's failure. I think that is wrong as well.
And the other thing, too, is that is there a need for small banks? Because small banks used to be nice because you go in there, you would meet the manager, you know people, you almost would know the president. I mean, it was a small commercial or not commercial, but community bank that you would go to and you felt together with them. Now, because of all banking being done on your phone, internet, everything else, you don't have that relationships. Why do we need a small community bank? Because you don't see those people anymore. You don't go in there. Everything is done online now, pretty much. Yeah. I'm still the guy, and I've not done it recently. I used to go in every month in my bank, just kind of say hello and do a withdrawal or something. But I don't even do that anymore. You just don't need to do it. So why do we have community banks? They're really losing a big benefit of that relationship of face-to-face meeting with people where everyone's the same. It's just like, what are you going to pay me? What are you going to do? How good are your transactions?
Yeah, I know. And the crazy thing as well is you kind of talk about the digitization of it is that's what's causing a lot of the problems as well. But before, when you had bank runs, right. Get this, you had to get in the car, drive to the bank, and ask for your money back. Now you go on the app, and it's done like that.
You know, and I saw some pictures of that where people are outside Silicon Bank, like, do you not have a phone?
I guess maybe they couldn't access the account, so I'm going to the bank.
Yeah, I think that was.
Probably a lot of them didn't even know where the bank was.
Yeah, that could be. I didn't even know they had branches, yeah. So, but it is something that I think we will see changes in the banking system. And it is kind of funny, too, because back in 2008, get rid of big banks, get rid of big banks. Now, like, oh, thank God we have the big banks. You know, I mean, it's just something that people many times don't understand what the benefits of a big bank is. And again, you talk about a good point. Yes, they need to be regulated to a certain degree, but not, I mean, what worries me, if you insure all the banks, what that worries me is that perhaps you're getting closer to a nationalized banking system, which we don't want the banks nationalized because we don't want the government running them. We know how bad the government is. So, but that's just kind of the direction we're going. So we'll see what develops out. I'm on KSI tomorrow morning, talk about it more. And we're on top of that to see what happens. But again, we're very safe with the banks. The whole banking industry is pretty safe.
And I'm still confident. And, you know, it has hurt our portfolio a little bit as tech has done well over the last week. Mm-hmm. We've been stepping in and buying banks.
Yep.
And people I think we're crazy, but I think there's a lot of, as Barron said, buy the big banks.
Yeah.
I think, you know, you got to understand you're not going to buy at the absolute bottom, but I think there's a lot of great opportunity there in the big banks as they're selling off, not because of, I think, the right fundamentals. Yeah. They're selling off of, because I just got to sell and get out, and people always shoot first and ask questions later.
And then like, why didn't I do well? You should have asked questions before you shop. Let's move on to the CPI index, the Consumer Price Index. Inflation in the month of February continued its downward trajectory as the CPI increased 6% compared to last year. This was right in line with expectations and comes in lower than the January 6.4% reading and the peak of 9% in June of last year. Many of the normal culprits remained elevated, with transportation services up 14.6%. Wow, airfares were up 26.5%. I think that's going to slow down pretty soon. Energy services were up 13.3%. No surprise here. Electricity was up 12.9%. And utility gas services were up 14.3%. And food, well, that was up 9.5%. There were some positives as gasoline was down 2.5%. Citrus fruits were down 1.2%. I love this one. Beef and veal were down 1.4%, and banking was down 5.9%. Major appliances were down 5.9%.
And then also, too, we looked at used cars. Remember, this was a big one. Big one, up 30% a couple years ago. Well, now they're down 13.6%. And televisions also were down 14.8%. And it sounds like a lot of numbers there, but the reason I wanted to point this out, or we wanted to point this out, is it is nice to see there are more categories in these reports that are showing a decline. Before it was like, oh, there's one in the negative column. Right. Now there's starting to actually be more different categories in that decline. Now, looking at core inflation, which backs out food and energy, it actually came in at 5.5%. But the thing you got to look at here is a heavy weight in the report was shelter costs. That was up 8.1%. And if those were backed out from the core inflation, it would have been 4%. So we're starting to kind of see a lot of other areas slow down, and really kind of concentration in different areas lift the CPI, which means if things slow back down in shelter, that could bring down the whole CPI. And the thing that I look at here is we remain very optimistic over this trajectory because, again, we look at the shelter index. It actually really lags real-time data, as leases, it takes about 12 months for those to come through because landlords, again, they typically renew those every 12 months, which means current price dynamics won't be reflected in new contracts for a year. So, I mean, you got to think about there's people that signed a lease, we'll call it 11 months ago, where they're locked in now.
Yeah.
For only 1 month, but people just signed at least 6 months ago where they're still locked in for another 6 months. So it's kind of this rolling data, and we know home prices have started to come down. We know rents have started to come down. So I wouldn't be surprised to see the shelter index cool going forward.
And again, we talked, I believe it was last week, that we are seeing rents throughout the country drop down at a good pace. But you're right, in this report, they don't come up until 12 months later. So the report does lag, which tells us, and this is why people, inflation's gone up. We look at what's going on down the road. We analyze the data and saying, here's another factor with this rent situation that's going to be lower 12 months from now, and it'll probably start being lower a little bit each time over the next few months. So by the end of the year, we should not have an inflation problem. And by that, I mean inflation could be at 3 or 4% by the end of this year, maybe even lower. I mean, we'll see what happens there. But one thing I did want to pull out was televisions. Down 14.8%. I remember you used to get a big screen TV. It was like $5,000. Yeah. Now you get, I think it's going to be where they're going to give the TVs away because now you get a big TV, I think for like a decent one for, what was it, $400 or $500 for a 50-inch, 60-inch TV?
Yeah. I mean, it's crazy. I haven't gone shopping for a TV in a while. I'm pretty set, but yeah, it's great. It's like, it's pretty easy to upgrade a TV now because it's only a few $100.
Yeah, and I did like that. Some food was down. The beef and veal were down, and those are two big factors: beef and veal. I love both.
Yeah,
so,
no, absolutely.
And here's a big change too, and this is something else we look at because Producer Price Index, also known as a PPI, came in with a huge surprise, declining. That's right, declining 0.1% in the month of February. Versus the expectation for 0.3% increase. Now, compared to last February, the PPI grew just 4.6%, which is down from January's annual gain of 5.7% and well off the peak level of 11.7% March 2022. This was the lowest annual increase since March 2021 when it was 4.1%. Now, retail sales did show a 4.4% decline in the month, which could be good news considering it indicates a slowing economy. Year over year, retail sales were up 5.4%.
And then looking at food services and drinking places, well, they still remained a big destination for consumers' dollars as sales were up 15.3% compared to last February. Non-store retailers also did well, up 8.5%. And grocery stores, of course, with the higher food prices, they were up 5.8%. Now, areas of weakness included, again, those electronics and appliance stores, down 2.8%. Motor vehicles and parts dealers were also down 0.2%. And this one will shock some people, but gas stations were down 1.9% due to a decline in gas prices. Now, I continue to believe that the data is showing a softening in the economy. Now, softening is very different than a decline.
Right.
So I want to point that out. But it is providing relief to the high inflation levels we experienced last year. And I continue to believe the Fed should hold rates where they are for the time being. But with that said, I still do not believe they should cut rates at all in 2023. And I saw this thing I was reading Fox Business this morning. Kathy Wood was like, yeah, the market's showing that the Fed's going to need to cut interest rates by the end of the year.
Oh, my gosh.
And of course she wants them to cut interest rates. That'll help her crazy investments in frothy tech companies. But I can't see the need to cut rates. And you may be pointing to the banking issues that are occurring, but I again think this is going to be resolved here in the next few months. And I think cutting rates would be a huge mistake, and that could kind of create a re-acceleration in inflation.
And I think cutting the rates would not really benefit the current banking situation that much. And I think next week when the Fed comes out, I do believe that they're going to raise rates by 1/4 point. I think that's going to be done. I agree with you. I think they should not do anything until the end of the year. Let's see what happens now that we have this. I think that will put us in a great situation towards the end of the year. I think the last 6 months of the year on the markets, I think will do very well. And 2024 could be set up to be a good year as well. If they don't move too quickly. And again, I think the 1/4 point raise on next week would make sense, and then just let that take effect for a while, because we're talking now about things coming down. And the reason why the PPI is so important is that's what is before the consumer. So if their prices are falling, they're going to start becoming more competitive, which will bring down prices even more. which will benefit the consumer. But it doesn't happen next week. It takes time for that to filter on through. It's, again, another positive thing that we're seeing with inflation. And then people get too emotional, like, oh, it's going up, it's going up, it's going up. No, look at the data. Yeah. The data is telling you that we're on a good path. And it's not going to happen on Monday like everything's fine. But by the end of the year, I think we're looking at a pretty good inflation rate that everybody's happy with. The economy can pick up and go. And gosh, 2024 is the election year. I just realized how fast time goes.
Well,
but
I also think, too, with that interest rate is, you can argue, of course, the need to cut rates to where they were to help kind of spur demand and so forth. But you can't have rates at 2-3% to borrow long term. That creates way too many issues in the system. Right now, I think we're at a pretty fair interest rate.
Yes.
And I think it creates enough where there's still that rate can encourage investment because you can still make money by borrowing at, I'm going to say 8%. You can still make money by borrowing at that rate. But it's not just easy money where everybody can borrow and everybody's going to make money. That creates a lot of issues. Now you have to be a little more selective with how you're going to borrow and invest. That creates a lot less froth in the economy. I think we're at a very good, what the Fed kind of calls terminal rate, where it's a fair rate. I think it is a fair rate. But cutting rates is, I think, would be problematic. And the other thing that I think is funny is when you look at these banks, they need to cut rates because these banks, if they sell off the bonds, they're taking losses and so forth. Well, what's happened now is with the interest rates pulling back down, those bond prices in the portfolios for these banks have now gone back up, kind of already solving the problem. And we're also not going to have, in my opinion, more increasing interest rates. So the banks, what they need is they need more stabilization in interest rates.
Yeah, and I was going to say that if they can stabilize, the banks can work with it. We are looking at another sort of bank, we'll call it, and they're in a similar situation, but they said they have plenty of liquidity. I mean, hundreds of billions of dollars of liquidity. It's a big institution we're looking at. We're not going to tell our listeners what it is. You got to kind of guess, got to kind of figure it out. But it's just something that will do very well over time, and they can handle that. And that's what you have to look at. And if things stabilize and rates don't go up, they don't go down, everybody can do well. And we were fine with interest rates at 4 or 5%, 6% before. We should stay at that level because you want to be able to do something when maybe perhaps in 225, 226, we do have another recession. You've got to have something you can help that recession with and to lower rates. But if things are bad, let's lower rates again, you're going to boom the economy, you're going to have inflation come back. So let's get rates up. Let's keep them there. Everybody can make money with rates. What are mortgages now? 6%, I think on average?
6 to 7, I mean, depending on the points.
Right.
And
I think a 6%, 6.5% mortgage, it's not as good as 2 or 3, but you can still make a good argument that, that's a good rate, and I can afford a home. Maybe housing prices we talked about will come down somewhat to justify that, but you can have a good economy with a mortgage rate at 6% or so.
And you create a lot less risk.
Yeah.
And that's what these low rates did is they created a lot of risk-taking and a lot of, again, froth, which, as what's the saying Warren Buffett has, when the tide goes out?
When the tide goes out, you see who's not wearing a bathing suit.
And the first part of it is a rising tide lifts all boats.
Right.
And then, when the tide goes out, you see who's not wearing a bathing suit. And I think there's a lot of people that were swimming naked.
Swimming naked, yep. And now we're seeing whoa, that's not a good sight, I'll tell you. And we probably, we're in for more. Like First Republic, I think 11 banks did loan them. I think it was $30 billion for 120 days. So that's a positive. We need to get through this little storm that we're having here. Let's move on because the last thing I want to talk about, and let me get the phone numbers as well. We talked quite a bit, 11 important topics here. You want to get through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Give us a call at 833-288-0973. That's 833-288-0973. We do have a few emails here as well to go over. I got one from Don, another one from Jason, and then another one from Zach. So we'll try to get to those as well today. But just real quick on the gas prices, I think this was important. You may not be able to tell by the price of gas at the pump here in California, but oil has dropped down to under $70 a barrel this week. I think I saw it yesterday, $66 a barrel, I think on Friday is where I saw it. Remember last year, about 9 months ago, when crude prices hit $122 a barrel? Well, I'm certainly glad those days are gone. The reason for the decline is with the bank failures and also a big sell-off in the international bank Credit Suisse. Some are thinking the economy is slowing down and less oil will be used. It will take a little bit of a time for the big reduction in the price per barrel to flow through the pump at the gas station, but it may not last that long.
And we also have to remember, we do have that reopening of China's economy, which could increase demand for petroleum. And again, remember all the oil that was taken out of the strategic petroleum reserves? It made a lot of news there.
Yeah.
Well, that must be replaced. The talk was they should be buying it back anywhere between $67 a barrel and $72 a barrel. Let's see if the government follows through with their plan, because if they do, they would put more upward pressure on the price of oil by creating that demand. So I think, as you kind of said, it is. I don't think we're going to go back to $122 a barrel,
right,
but I think we are going to come off these prices in oil as well.
And I really would like to see the government start buying some oil and push that price back up a little bit, because if they don't, the Saudis could say, oh, we're going to start cutting production because oil is too low. So let's have the government, as they said, do something that they said they're going to do and start replacing those reserves at these levels. And I'd say up to 75 to get that price of oil back to 75. Because at 75, here in California, you can probably get gas somewhere around $4 to $4.50 a gallon, which is not great, but I don't like seeing above 5 or 6.
And I have to, again, point out this is huge for inflation because, again, that is a huge input cost to our economy, whether people want to believe it or not. Energy prices, you look at transportation costs, and who uses transportation? A lot of different companies. So having these lower energy prices is a great benefit to the input cost for these businesses, which I think is, again, a benefit to inflation for the months to come.
All right. Phone numbers here, 833-288-0973. That's 833-288-0973. 73. And I'm looking at, let's see, we got Dwayne in San Diego. Dwayne, can you hold with us for a little bit? Because I do want to go to Harrison, because Harrison's going to be talking about where should you put your cash. I think it's a pretty important topic. So, Dwayne, stay with us for a few minutes while I talk to Harrison. Good morning, Harrison. How are you doing this morning?
Hey, guys, I'm doing well. How are you doing?
Good. I like the topic this morning. Where should you put your cash? I think a lot of people are thinking that with the banking situation. So I'm going to turn the mic over to you.
So, yeah, I've gotten a lot of questions about this, given the banking situation and interest rates and everything. So as far as safety goes, most banks out there are either FDIC or NCUA insured. FDIC is for banks is the Federal Deposit Insurance Corporation. NCUA is for credit unions, and that's the National Credit Union Administration. Both are federally insured and give the same type of protection. FDIC limit is $250,000 per person per bank. So if you have a joint account, it's $500,000, and you can split money up over multiple banks to get more protection. So one thing I wanted to point out is most people think that the FDIC is out there to protect us, the consumer or the depositor, but its main purpose is out there to protect banks. So banks get in trouble when people lose faith in that bank and pull their money out. And if the bank has loaned out too much money and then too many people withdraw their funds, the bank could fail. So the act of people thinking the bank might fail is what kind of speeds up the process to make that bank fail. And so since the FDIC now insures those deposits, that gives people confidence that their money is safe, which prevents them from pulling money out of the bank, which in turn keeps the bank from failing. So I thought that was kind of an interesting point to bring up. But as far as where to keep funds, a lot of the large banks out there are still paying basically nothing, even though interest rates are higher. So, you know, the Wells Fargo, Chase, Bank of Americas of the world on their savings accounts still are giving like 0.01%, 0.05%, so basically nothing. But there are some smaller banks out there that are still FDIC insured that have savings rates that are a whole lot more than that. One I like is called CIT Bank. I checked yesterday, and its savings yield rate is 4.4% right now. Another bank is Synchrony Bank, that yield is 4% right now. A lot of these banks have been increasing their rates over time as the Fed has increased rates, so they've kind of been keeping up with it. Now, these are smaller banks, so I would not have more than the FDIC limit, but for emergency savings or liquid funds, it pays a whole lot more than the bigger guys. And another alternative that I like is T-bills. So what I like about these is They don't need FDIC insurance because they are backed by the full faith of the federal government. So by definition, they are risk-free. Also, the interest that you earn on T-bills is only taxable federally, not on the state side. So unlike savings accounts or CDs that are taxable on both the federal and state side, T-bills are just taxable on the federal side. Right now, 1 month, 3 months, 6 months, T-bills all have yields in the 4% range right now. For a while there, it was over 5% on the 6-month T-bill, but that's kind of come down in the last few days. But the yield is still good. Then again, it's better on the tax side. So I like these better than CDs, or for people who have more funds than what the FDIC covers. And the other thing I want to make clear is this is, a good place to put cash, whether it's, these FDIC-insured high-yield savings accounts or T-bills. But that does not mean that all of your money or your total portfolio necessarily should be going into these things. Everyone needs some amount of cash, and these are good places, but I think in the long term, there's still a lot better other places to put long-term investment money, which is, what you guys, Brett and Chase, are talking about.
And here, some people really have to think about what is best for them, because one difference with CDs versus T-bills is that T-bills are bought at a discount, so therefore there's no cash flow from interest until it matures. You get the money back that you actually put in because you bought at a discount, whereas a CD can have a monthly cash flow for people on the CD. So there's just different things, and I think it's a little bit easier to get the CD. I really like the idea of the CIT bank, the Synchrony bank, because it's convenient, good yield. You don't get the tax benefit of the state, but it's just sometimes convenience, depending on how much you're doing. If you're doing hundreds of thousands of dollars, maybe it is worth doing the T-bill. But it comes down to each situation, understand what's best for that individual.
And I think the big thing you pointed out there as well is, again, these banks are FDIC insured. So I'm not worried about, losing that money in the bank. I would say, though, I'd be careful of putting like a checking account or something at these smaller banks just in case you need liquidity. Because just because it's FDIC insured doesn't mean that you'll be able to get the funds out the next day. So if you have, again, the purpose of a checking account is to pay your bills, I'd be very cognizant of where I'm putting my checking account or making sure I have other liquid sources that I can get money out of.
And here's an interesting question. So you said your checking account. So it's Friday, and we'll use Silicon Valley Bank.
Yeah.
So they were okay by Monday. So on Saturday, you write a check and you send it to your utility company. I think you're okay because come Monday, it was all right. Yeah. So, but you couldn't go into that checking account, pull it out, but you can still write checks against it because it probably would be the government's not going to wait, a week or two to cover those insured deposits. So it's just, again, coming back to what is your individual needs. So if you use the ATM, you may have problems. Well, Harrison, thank you very much. Great information, especially this time when people aren't sure what to do on the banking and the short-term money. That's a great segment, and we'll see you on Monday.
All right, thanks, guys. We'll see you Monday.
Okay, bye-bye. All right, there's our financial planner, Harrison Johnson. He is a CFP. He's on a salary. He does not charge, or sell products to charge commissions. He is a fee-based financial planner. If you want to sit down with a free consultation for him, give him a call at the office, 858-546-4306. That's 858-546-4306. You can also contact him through email on the website. Our website address is smartinvesting2000.com. That's smartinvesting2000.com. And Chase, I forgot when we were done before to promote the newsletter as well. Because if you're there, want to talk to Harrison, also the newsletter. That's where you get it. Go to our website, smartinvesting2000.com. Right in the middle, you'll see the newsletter. Free newsletter goes out every Friday around 5 o'clock with good information on it, like we're talking about here on the show. All right, phone number is 833-288-0973. That's 833-288-0973. As promised, let's go out to San Diego and speak with Dwayne. Dwayne, you're on the Smart Investor over at Chase. How can we help you?
Good morning. Thanks for taking my call.
Sure, thanks for waiting for us.
My question was about, you betcha. My question was about United Healthcare stickers, UNH. I've had it for a few years. It's done well for me. Seems to be awfully volatile, but that is what it is. I'm just considering whether to keep it or liquidate some of it.
Okay. And we'll go over the numbers here for you. You say liquidate some of it. What % of your portfolio does United Health make up?
Let me check here. Right now, it's... where is it? About 5%.
Okay, yeah, I was going to say about 5%. You sound like a 5% guy. Okay, so we're okay with that. And one thing I do want to point out too is that United Healthcare plans, I mean, these type of companies, insurance companies, are also getting, I think, a little bit of downdraft from the whole banking situation. So I think when Chase looks at the numbers, I think we'll see the stock is probably down, but we'll cross that bridge when we come to it. They are in the health cam plans industry, only 0.5% float, 90% institutional owned. PE ratio a little bit high, 22.2 versus 21.6. Price of sales 1.4, also high compared to the industry at 0.7. Price to book value 5.6 versus 3.1. Price to cash flow 17 versus 12.1. PEG ratio 1.4 versus 2.4. That's positive, but all the valuation ratios are higher in the industry, which could tell us this company is a little bit too pricey. We do see that last year earnings were up 17.1%. That did beat the industry growth at 16.8. Sales did climb by 12.9%, also above the industry at 10.8. So you are paying more on the valuation ratios, but they appear to be delivering a little bit more as well. They pay a dividend of 1.4%. They use 29% of their earnings to pay that out, so that's okay. Look at the balance sheet. They got a current ratio of 0.8 versus 0.6 for the industry. That's good. We see debt to equity 0.7 versus 0.8, also good. Net profit margin 6.3 versus 3.1. Return on equity very good, 25.9 versus 21. Chase, I'm kind of liking a little bit what I see here. I think I'm going to know the results, but go ahead. What's it look like going forward?
Yeah, so current price here for United Health Group is $469.50. The 52-week high is $558.10, and the low, well, that's $449.70. Year to date, it's down 11.1%. I was actually surprised to see this 5-day return. It's actually up 2%. Reason I think a lot of these companies that have investment portfolios and insurance companies, many times they take those insurance premiums and then they buy bonds, buy different investments. I, again, think they're kind of getting beaten up as a group because, they have bonds, they're going to get crushed. I don't think that's going to be the case for these insurance companies, but I think there could be some opportunities. I was a little bit disappointed though, and I'll tell you why. I go out to December 2024. I see estimated earnings per share of $28.32. Gives it a target sell price of $470.11. Forward PE is out 16.6.
Yeah.
That's right exactly where we sell out at. I do think this company is fairly valued. It's not overpriced, but it's definitely not a value at this point, I wouldn't say.
And kind of comparing, we won't tell the name of the company we have in our portfolio, but compared to the company that we have, that's in the similar category. Ours actually became a buy. There's still about, I think, a 35-40% potential growth on our
12
company.
times future earnings.
Yeah, 12 times future earnings. So United Health, based on what we're seeing here and what we have invested in, I would say I would probably recommend to sell this and look at something trading at 10, 12 times earnings. So it could turn around, go back up, or it could go lower, or could be flat for a while. So if you came to us and you were going to manage your money for you, we'd say, we want to sell United Health. So I'm going to sell it.
And it's done tremendous over the last 3 years, 5 years, 10 years. But I do think they're going forward over the next 10 years. I think a lot of the excitement and the outperformance is kind of in the past.
All right, Dwayne.
Thank you very much. Yes, sir. I appreciate it very much.
All right, thanks for calling. Have a good one.
You too. Take care.
Okay, bye-bye. That does open the phone line, 833-288-0973. That's 833-288-0973. Let's go to one of our emails here from Don. He says, I am unable to call into your shows on Saturday morning. If you get the chance, could you go over the stock for Berkshire Hathaway B shares? Now, I think that is, and we'll see and pull this up, I think it's BRK. There it is, yeah. There it is. And it comes up with a .B is what it comes up. So, and I've got to talk about this a little bit because we like Warren Buffett's philosophy. I do believe, we said this before, that more and more, I think he is not making the decisions. His two co-captains will call him or make the decisions because they do things that just don't make sense. They sold a big position they had in Taiwan Semiconductor. It's not the same as it used to be years ago.
There's a lot more trading, it seems like.
Exactly. And they got a big position in Apple, which I'm kind of surprised on. I that does kind of worry me. But let's look at the numbers, how we look at it. Beyond the industry of insurance diversified, only 0.5% flow, only 65.9% institutional owned. This surprises me. PE ratio, nothing. Versus 40.8. There's no PE ratio for the company. We do see price of sales 2.8 versus 1.3. That is high. Price of tangible book value 1.8 versus not material. Price of cash flow 17.4 versus 11.7. And pay going forward is 0.8. There's nothing there for the industry. Now, there's no earnings that we see here from the company, which is strange. And sales are down 34%. The industry is down 35%. And again, we got to remember this is Berkshire Hathaway, how they're a management company, but they're an insurance company, so a lot of different things there. They do not pay a dividend. We do see that on the balance sheet, again, they don't really have your normal banking, the normal balance sheet. It's more like a banking balance sheet, no current ratio. Debt to equity is good, 0.3 versus 0.5. Net profit margin, negative 9.7 versus 3.8. And return on equity at negative 4.8 versus negative 3.9. These numbers surprise me. But we got to remember that this is a really conglomerate of different things. But it's not exciting me at all that I'd want to be in this.
Well, you got to remember, again, they own Geico. They own a railroad company. I think it's Burlington
Northern.
Yeah. They own
See's Candy.
I mean, they have all these other businesses in there. And the thing that I think is genius that Warren Buffett has done is, years ago, he takes those insurance premiums and then he invests in equities.
Yes.
I mean, that's how that equity portfolio has grown to be so massive, is because he's been taking those insurance premiums and investing them for years, which is, I think, genius. Right. But the thing that I got to point out here, I'm kind of surprised. Again, looking at the Berkshire Hathaway B shares, the current price $293.51, 52-week high $362.10 in the low, $259.85. Year to date is down about 5%. But the reason I'm surprised is you look over the last 3 years, the stock's only up 56%. Over the last 5 years, only up 41%. And even over the last 10 years, it's only up 185%. I say only because it hasn't outpaced the S&P. A lot of times people go, just buy Berkshire Hathaway.
Right.
I think those days are again in the past. Especially I go out to December 2024, I do see estimated earnings per share of $18.18. What gives the target sell price of $301.79? It's again a forward multiple of about 16.1. There are only two analysts, so I do want to point that out. It's not a heavily followed stock. I think a lot of times people maybe don't want to break down all the different businesses. It'd be a very hard company to analyze, but I don't know. I don't think it's an exciting buy at these levels is the best thing I could say.
And I think the best days have come and gone for Berkshire Hathaway. And again, I still believe 100% in the philosophy of Warren Buffett.
Oh, yeah.
But those days are gone. I mean, what he did is not going to happen again. The philosophy remains, always will be good. But I think the new guys are trying to outperform him. I forget their names. Ted
Wexler and Todd Combs or something.
Oh, what a good memory. Yeah. I just think they have a different philosophy. So I would not be buying. I would not put any money into Berkshire Hathaway, A or B.
Well, and the funny thing is, you talk about those two guys. They don't run Berkshire Hathaway. They run the investment portfolio of Berkshire Hathaway, and then they're not. I don't think they're in line to be the CEO. They've talked about, I think, the Geico president becoming CEO of Berkshire Hathaway.
Yeah.
So, but that is a large part when your investment portfolio is that large. You got to make sure the investments are doing well within it. I think Geico is going to be fine. I know I like insurance companies, but I think Geico within that business may be a little bit overvalued. I think you could find other property and casualty insurers at a better valuation than buying Berkshire Hathaway to get Geico.
Yeah, and I would say that we manage our portfolio more the way Warren Buffett used to do it years ago, not the new way.
Yeah.
I mean, and it's worked out very well for us. I think I can say this. I'm always concerned about the SEC. I think we can say, because we're not given numbers, that we have done better than the Berkshire B shares. And I think it's safe to say that. So SEC, because I didn't give any numbers.
I don't know. We'll just move on.
Let's just move on. Okay. SEC, if I said something I shouldn't have, I apologize, but I didn't give any numbers. So, I would have put my money where I did. And again, if I didn't, why would I?
Yeah, I would just buy Berkshire Hathaway.
Yeah, just buy Berkshire Hathaway, exactly. All righty. Let's go back to the phones here. We got some time here. Let's go down to Chula Vista and speak with Jim. Jim, you're on the Smart Investor, Brent Chase. How can we help you?
Yeah, I'd like your opinion of MTW.
Okay, do you hold that or looking to buy it?
I hold it. I just bought some more of it. I'd like to know what your opinion is.
Okay, let's take a look at MPW. That is, let's have it come up here. Medical Property Trust is what it actually is.
Right.
There it is. Yep. Symbol MPW there in the healthcare facilities area. Float is high on the short, 26.2, institutional owned, 84.6. PE ratio very positive, 5.2 versus 34.7. And I've got to point out as well that this is a REIT. So it's more we look at the funds from operations versus the PE ratio. But I think, Chase, you have that. So Chase will give us that. I'm just going to look at the PE ratios here, the normal numbers. Price of sales, 3 versus 4.8. Price to tangible book value, this is amazing, 0.5 versus 9.5. And what that means that for all the tangible assets that this company holds or this REIT holds, which are hospitals and healthcare facilities, you will pay 50 cents on the dollar, which is just crazy. Price of cash flow, 6.3 versus 15.1. PEG ratio going forward, 1 versus 39, and the lower the better. Now, earnings per share over the last year were up 35.1%. The industry was down 21.3. Sales did decline by 0.1% when the industry was up 13.8. Their 5-year estimated growth rate by the analysts is 7.1%, about half the industry at 14.6. You do now get a 15% yield on this company because of the fall in the stock price, where the payout ratio still based on earnings is only 77.3% versus the industry at 243. So this company's looking pretty good on that. We do see that the current ratio is 1.1. That's below the industry at 2. Debt to equity 1.2 versus 1. I'm okay with that. Net profit margin, this is kind of a strange number. I'm not sure why, but 58.5 versus 14.2. And return on equity is 10.5 versus 1.8. Chase, what do you got?
Yeah, so current price here for MPW is $7.73. 52-week high here, $21.63, and the low, $7.60. Year-to-date is down 28%, and over the last 1 year it is down about 58%. And I want to say it again. Did you bring up the short level?
Yes, I did.
Again, 26%. And I at some point believe these shorts that are on this stock, you've made money off this now. Congratulations. At what point do you start to cover?
Yeah.
Once you have 26% of those shares short, they got to cover at some point. And they start to cover, they're going to push that stock price back up. And I think if they start to say, we've made 70% off this short, let's get out of it and move on. I think if you can get that uncovering there, it would really help the stock as well.
And just let me jump in there real quick. Unless this company is completely lying and falsifying statements, they're going to have to cover because it can't just keep going down because they got the earnings, they've got the assets, they've got everything there. These shorts are creating, I think they could be putting out some bad news, but I'll let you continue. I just want to kind of jump in on that real quick.
Yeah, again, what we look at is the funds from operation, a better idea of cash flow because, again, real estate companies, they charge a lot of depreciation. Well, depreciation is not going to impact their ability to pay dividends because you're not writing a check for depreciation every single month. So that's why we look at the FFO to get a good idea of the cash flow. Well, I go to December 2024, I see estimated FFO of $1.64. It actually gives us a target sell price of $27.22. I mean, the forward FFO ratio is about 4.7 times. I mean, that is just ludicrous. That is so inexpensive. The other thing I do want to point out is with these REITs, you got to be a little bit careful. You got to look at the accounting. There's something also called adjusted FFO. You want to look at that as well because what can happen is these companies do what they call straight lining rents. Because, we just signed a lease last year for our office space. Yep. Well, we didn't pay rent for 7 months because we got that as a concession. Well, now you're not getting that cash flow for 7 months. So what they do is they straight line it. So you're not really getting the cash flow. So it really overstates the cash flow in the first 7 months of our lease and understates our cash flow after that 7-month period. So just kind of trying to understand the accounting of what they're looking at for the rents is also a very important thing to make sure they can pay out that dividend, make sure they can still have money to invest in the business as well.
And I think, too, with this one is that because of the shorts, I think a lot of people are running scared, and the shorts like it because the stock goes down even more. And then the banking situation didn't help because that hurt a lot of REITs. But fundamentally, I mean, everything we see on this company, this is like a screaming buy.
Yeah.
And I said the only way this can fall apart is that if management is just making up these numbers and they're really, just falsifying all these financial statements. But I think the market cap you said is what, about $5 billion. I think it's still a good size, and they own hospitals, surgical centers. I mean, they're not going out of business. It's not like oil to where the price of oil could fall. I mean, price of healthcare is actually going up, and population getting older. I just cannot understand why this one is trading at this level.
And I do believe as well that these REITs are getting hit hard by this financial situation because of concerns over maybe community banks shutting down and then having a harder time getting loans. I think, again, it's all overblown. People that has anything to do with financial right now is selling off and they're buying tech, which I think is silly. Right. And I think 5 months, 6 months from now, that's going to be a terrible decision. I think the financial related sectors like real estate could offer some really good opportunities. And the other thing I want to point out, though, is with these REITs, you got to understand how their balance sheet is kind of in their current situation is how much do they have in variable debt and how much do they have in debt coming due? Because interest rates are higher now. That is going to impact their cash flow because they're going to have higher interest payments. But if they have a low amount of variable debt and debt that's not coming due for 2, 3, 4, 5 years and maybe even longer, that is the type of REIT that I want to own.
And I think this could be one of those situations in 2024. You look back like, why did I not buy MPW at $7 a share? I could have locked in a 15% yield, and now the stock is up 100%. That this could be one of your best investments ever. And the only thing I can see, and I'll say it one more time to make sure people understand this, is that if the company is flat out lying and falsifying statements, this will probably fold.
And I do want to say as well, the other crazy thing is, with that 15% yield, I don't foresee this happening. Let's say they cut the dividend in half. Yeah. It's still 7.5% at this rate. And I mean, their cash flow, if they cut the dividend in half, they have more than enough cash flow to cover that dividend. So now they have way too much cash flow, in my opinion. So it's crazy when I actually look at the numbers for this business, and I do think it is, again, as Brent said, a screaming buy here.
Yeah, Jim, I think we said quite a bit about that for you. Did that help out?
Yeah, that helped out considerably. I think one of the problems with these REITs is my understanding is with commercial loans, the loans reset after 5 years or so. But new interest rate, maybe that's what's pushing it down too.
Well, that's where, again, you got to understand their balance sheet, see what type of loans that they have. And the other thing that a lot of these REITs have baked in is they have inflation adjustments to their renters as well. So that could kind of help offset some of the increase in interest rates and kind of maintain cash flow. So each REIT is not going to be the same. Right. You got to look at that REIT individually and make sure they are able to kind of weather those downturns and get through what is a difficult situation.
And that, we believe, is creating a great opportunity because all REITs are being like, oh, they all have these problems, so they're selling them, not dwelling down into what are the loans of the REIT, what are they really doing, what is their product, and so forth. Again, I think it's created a great buying opportunity on this REIT.
Yeah, they have a hospital in Pennsylvania, and Pennsylvania is not paying their rent consistently, so that's another issue with them.
Yeah, and you got to look you got to look at their tenants one by one, and you're going to have a bad tenant from time to time, but looking at the tenants as a whole, you got to look at their cash flow, see how widespread that problem is when analyzing these REITs as well.
And we know about that one in Pennsylvania, but the thing is, I don't pay their rent. Someone else will come in and buy them, which did kind of happen, and they will pay the rent. So it takes time, but that's what I'm saying. I just don't see how this is a great business. It's not a dying business where it's like an old ATM machine, which ATM machines aren't as popular as they used to be. This is something that's going to get better as go on. We need the hospitals. We need the surgical centers. It's not a dying business that can be replaced by technology.
Yeah, that's a REIT I would not want, ATM machines.
I think we did a post on that, how they are going down. Yeah, less ATM machines out there. So Jim, I hope that helped out for you there.
It did. Okay, well, thanks a lot, guys.
All right, well, thanks for calling.
Okay.
Wow, we timed that pretty good. That's the closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail needs your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306, and visit our website, smartinvesting2000.com. Remember, we got that great newsletter there. You can read it in about 3-4 minutes. Great newsletter. You can get it for free at smartinvesting2000.com. Thanks for listening to the Smart Investing Show. Have a great day. We'll talk more next week right here on the Smart Investing Show.